People need an income that's guaranteed to them.
If you lose money to taxes, you're never getting that money back.
You need to get serious about adding some lower risk.
Greed. I don't like greed.
The thing to be afraid of, honestly, is the thing that we're not thinking of, the black swan event.
There's a tsunami coming. Bye.
Welcome to Retirement Coffee Talk with Charisse Rivers.
Just coffee talk.
There's a lot of noise, a lot of chatter. Who do you listen to? Who do you not listen to? You have to stay focused.
A fun and informative look at the issues of wealth, retirement, and protecting your life savings.
These advisors out there that were trained to sell, and have all these fees. They don't want to talk about this product, so they make less money.
And now, Retirement Coffee Talk with Charisse Rivers.
Welcome once again to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. My name is Randy Cook, and each week Charisse and I sit down here and talk through some of the things that are going on out there on Wall Street, and there is no shortage of that right now. But we also talk about how we should react to all this. If you're getting close to retirement and you start to see your accounts going down, that's never a good day. And how do you get some help, and who do you get help from? That's why we introduce you to Charisse Rivers at Zinnia Wealth. How are you doing today?
Oh, I'm doing great. The market is wonky. I call it the wonky roller coaster.
Yep.
But other than that, we really got things in control here, not really getting a whole lot of calls. We got plans. People feel confident. And we just took some of the staff to a John Gordon event in Orlando. So we're overly pumped up this week. Yeah. John Gordon, he is, if something ever happens to John Maxwell, John Gordon's basically the next guy, underneath him. He's in his 50s, John Maxwell's in his 70s. And they help each other actually, which is pretty cool. But he's a teacher, he's a motivator, he's an author. He's a very special person to me and his family. And it was nice to get the staff with other teams, us learning some basic stuff. And it's exciting. Love to bring him to Ocala one day. He saves lives when it comes to principals and teachers and just any kind of business you could own. It's just very common sense storytelling. We love storytelling and how to do it and an application to make things better, right? It's all about culture, whether it's in your households or your communities and or your offices. So it's really great. It's definitely, our culture is outstanding here. And we thank John for that, actually.
Well, it's one of the things that you've talked about many times, that you're continuing to educate yourself, educate your staff, how to help people and deal with some of the emotion roller coaster that is going on right now, because this is when a lot of people will say, holy cow, they hit themselves in the middle of the forehead and go, I knew that I should have sat down and talked to somebody, and then I didn't make any money moves, and now look at me, I'm $75,000 down, and so that is probably where we're going to start here today. The market has been swinging back and forth. I mean, we went way down, and then in one day we recaptured like half of it, and then we lost another half of that. And I mean, holy cow. But it's interesting to me, Charisse, that you're saying to me that the phone is not ringing off the hook at Zinnia Wealth, and that's got to be because you've created plans so that when times like this take place, you don't panic, because you know that you're in a position where the market's not going to hurt you to the point that you have to change your lifestyle.
Exactly. We're not here to pick up the phone to buy and sell every time the market goes up or every time the market goes down. We have a plan. In our portfolios, we can day trade. We can do quarterly trading strategies if that's what you want. So we have different buckets doing different things. And when the market goes down, some stuff goes down a little bit. Some stuff might go down a little bit more than a little bit, depending how much risk you want. And then some stuff goes up, which is crazy. Well, it's not crazy. It's our plan. And so people know that, so they're in control. I think a lot of people, especially nearing retirement and in retirement, they lose control. They get emotion going, right? I call it the big emotion, and people have stock market. So people fear when markets go down, running out of money because they're living on their money in retirement. So in our office, you're not living on all your money from the stock market, right? The stock market does not dictate your income. We're providing your income through different sources, and we still have some stock market money out there. Some people do use a little bit, but usually the stock market money is like our funny money. Hey, we need 20 grand for a trip trees. Hey, I need 100 grand for a down payment for my kid's house, those types of things. And so you want to time that, right? I mean, I got a client who's had $450,000 in cash. He came to me for a year because he's buying a house in St. Martin. And he said, hey, I feel like I really got to invest this money. This is back in January. Markets were blowing up. I said, no, stick to the plan. You're making 4% on your cash or 4.5% on your cash. And when you need it, it's there. And we just had a conversation the other day. He's like, okay, we got the cash there, Charisse. Should we just buy? Because I'm not going to buy this house in St. Martin for another year. And I went, oh, good gracious. I said, okay, so we had to talk him off the ledge, but then also maybe buy a couple of things, right? So we were able to meet the needs, but that's not the business that we're in. People who want to buy and sell when markets are down and trying to time it, we give people authorization on one of their accounts to go in and do it themselves. So they get to go to their Fidelity accounts, buy what they want. We show them how to do it. We educate. Because there's no way when you have thousands of clients that every single one of you can call into any office. I don't care if you're at Ray J, you're at Fisher, you're at Eddie's house. I don't care. Edelman, any of those financial planners. If you call your advisors the day the market's coming down, they're not going to be able to get back to you. Yeah. There's only so many hours in a day before that market closes, right? So we educate our clients that that's just not what we're doing here. But if you want that, we have different investment strategies that are already doing that.
So one of the things I got to believe that people think in their heads and may come to you with if they're a little panicky is, Charisse, get me out, put me in cash, stop the bleeding. I can't handle it anymore. All of that. If that's you, and I get that because that's the general reaction, then you have to say, when are we getting back in? And now you know what you are? You're a market timer. You're pulling out when the market's going down, and you're trying to get back in at the bottom. You're trying to guess. And, Charisse, we've talked about that over and over and over again. It's a fool's errand. Nobody in the history of the world can do it consistently, can they?
I have a friend who's got hundreds of millions of dollars. He's got a couple people in his life, but he says, Charisse, I'm thinking about going to cash. I said, why? Are you going to call me when to get back in? Are you going to call one of your other two advisors to get back in? He went, yeah. I was like, you want us to time the market for you. And then you're going to pull the trigger and actually do it. He's like, I think it will. I was like, just ride it out. You do not need this money. You have other monies doing other things. There's plenty of income. It's just this nonsensical version of our brains called big emotions hit us. We're like, what do we do? Should we do it? And we just panic. And so I get it. When you have a lot of money in the market, you're going to do that. And this is why, that 5 years before retirement, it's time to start learning that process of going from accumulation to decumulation and how you do it. It's a withdrawal strategy. We are very purposeful here at Zinnia Wealth Management and our team and our advisors because we want to make sure that those things don't cross your mind when times like this come. We want to make sure those checks are still flowing to you. You don't have to worry about running out of money. You can go book that cruise next year with the checks we have coming to you this year while your neighbor Bubba is like, oh, sorry, honey, we can't spend our money. Shoulda, coulda, woulda made a sell in time. That's not a stress-free retirement. When you turn in those keys to retirement, and you walk out those double doors with your last paycheck, you need to be absolutely certain where your money is coming from, how it's going to be delivered, what the other dollars are doing so that you don't get divorced in retirement, number one. Seriously. I had a client come into me, a spouse say, Charisse, I'm not doing good with my husband right now. He's very risky. He's not listening to me. And after 45 years of marriage, I'm like, you guys are having problems after 45 years? I thought that was the first 10. She's like, it never ends, Charisse. We just, we stay committed to God. It keeps us together. And I was like, you guys are like the sweetest couple in the whole wide world. I never saw that. She's like, yeah, we're having a little rocky road. I'm like, you know what? You made it 45 years. You got another 40. Don't you guys sweat it. I was like, keep doing whatever you do. So then they bought the property next door to them, and now she has her own she shed.
I need some space.
I need some space, exactly.
Yeah, well, we need to fund the space, yes, don't we? You're listening to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. Online, find us at zinniawealth.com, ZINNIA wealth.com. Down at the bottom of the right-hand corner there, you're going to see a gold button that says Complimentary Retirement Consultation. If it's time to talk about your retirement, if all this is really bugging you, give us a call. Let's sit down and talk through where your money is, find out what the purpose is. Maybe there's some better places to place your money and put you in a position that you don't lose like this market is taking away right now. Charisse, last week on the show we were talking about, and you talked about this when you did a radio show as well, is some of the things that financial advisors will say to you during times like this that aren't very comforting, like this too shall pass, hang in there, it'll come back, da-da-da. But I did hear this the other day, and it kind of made sense to me because you and I love Las Vegas. So if you were sitting at a blackjack table and the first shoe came out and you won $500 on that first shoe, it was going really well, and then the second shoe comes out and you lose 50 right away, and somebody, your bus buddy, comes in, hey, how's it going? Tips you on the shoulder. And would you say to him, I'm down 50? Or would you say, I'm up 450? And that kind of made some sense to me because over the last couple of years, the market has been so good to us, and now we're having a rough patch. Is it a disservice, that whole idea of don't look because it's just going to make you crazy? I don't know that that's really comforting to me, but it does kind of make sense to me.
People do in the stock market, if we're kind of pulling it back and forth to the stock market and the blackjack table, they have a hard time pulling that $50 off that $500 off the blackjack table. They really do. It's called greed.
Yeah,
Fear hasn't kicked in until you got to that negative 100. You put 100 in, you went to 500, you're getting greedy. The house always wins. And now you're down you're down the 100 you put in. So now you're chasing that rocket ship. You're like, I'm going to catch up. I'm going to get it. And you might not ever get it. So yeah, there's, what do you call them? Fishing stories along the way. And then it sets in, and then you're just like, oh, my ego's gone. Now I'm fearful. And when you're in the stock market, the one thing you don't want to do is sell when you're down. You want to sell when you're up. That is financial conventional wisdom. But so many people sell when they're down. It is amazing to me. And people wouldn't sell if they actually understood the math and how it all worked, right? There are calculations that you have to figure out on when to sell and how to sell. One thing on Wall Street doesn't tell you is when to sell. Financial conventional wisdom says buy and hold, everybody. But it doesn't say buy, hold, and sell here, right? And that's when you bring people like us in so we can help you make those decisions as you're going up. I mean, go back to COVID. Zoom, the stock was over $450. I'm telling people, let's sell because it cannot last. And what it do? It dropped to 100. Thank God we sold some of this stuff, right? And you just got to know when to buy and sell, but it's always when it's up. And this is why our portfolios work, because we're doing that inside our portfolios if you go with the active managed strategy. So there's a lot going on there, and so there's a lot to unpack. And so if you want safety built into your portfolio, yes, take some exposure off the table. If you are uncomfortable, right now you're thinking, I am so uncomfortable, I don't like the way this feels, I feel like nothing has been done, then give us a call because this roller coaster is not over. The tariff conversation is not done, and your next Toyota might cost you $10,000 more. So how are you planning? What are you buying in the next year to two in case we have hyperinflation for the short time? How much income do you need? Where and what pot is it coming from? It's so important to understand that withdrawal strategy.
You're listening to Retirement Coffee Talk with Sharice Rivers at Zinnia Wealth. If it's time to come in and talk about your retirement, and maybe this is the trigger that says, I've got to do something here, because if this were to happen to me while I was in retirement, I'd be hurting. And that's a great start to the conversation. Let's stop this now, and let's not let this happen again. No matter what the market is doing, we always say you don't want one eye on Fox Business and CNBC and the other on airfare because you want to go on your next trip, and then you go, now we can't go on my next trip because of this market. Well,
right.
Don't want that.
And I'm going to tell you, you will be pacing up and down the hallway at 2 a.m. saying woulda, coulda, shoulda, and your wife's looking at you like, oh, my God, are you kidding me?
Yeah.
Why didn't we do something?
Yep. Don't want to do that. Maybe you're a person who has, wanted to get to that $1 million mark. I want to get to that $1 million mark, and you have $950,000, and then all of a sudden this happens, and now you're looking at your account going, well, now I have $850,000, and you're just like, why didn't I do something? Why didn't I talk to somebody? Okay. Here's your opportunity right now. Give us a call. Give us a look on our website. 833-368-3680, 833-368-3680, or zinniawealth.com, ZINNIA wealth.com. All right, so being in Florida, there's a lot of people that come down here and spend some time during the colder weather months in the north. and you'll see a lot of different license plates. And I'll bet you've seen a license plate for Virginia, and it says Virginia is for lovers, and then there's hearts next to it. It's very sweet. Apparently, Virginia might be for lovers, but Virginia apparently is not for speeders. Virginia is looking at a new law right now that if you get convicted of reckless driving or speeding, they could put a governor on your car.
Where do you get this stuff? Who cares about Virginia? I'm just kidding.
Which would make sure that you don't go over the speed limit. Now I'll tell you why I told you that story. Okay. So, Charisse, we probably look at our portfolios right now, and we need a governor because we're going too fast. We have too much risk because we're losing too much money. So, Charisse, we come to you. You be the governor. You tell me how we're going to dial it all back and make sure we don't go over our financial speed limit.
Yeah, okay. So you did good job circling that back. I was like, governors. All right. There's so much to unpack in this. I like the governor idea, right? Okay. Reckless drivers. I'm good with that. It's controlling too much, right? There's a lot of control in the government. So, but maybe it's needed when you offend many, many times. And when you're talking about a portfolio and putting a governor on your portfolio, I do like that. Like some of our portfolios have governors, right? So that they don't go too fast and they don't go too slow, and they can work in both directions when the stock market's moving around. So I think just having that right asset allocation, having confidence in the plan, having a couple, like 5 to 6 buckets of income, 5 to 6 buckets of ways that you're earning interest rates, not just a 60-40 portfolio, is going to be in most people's best interest, to be honest with you. And so I think for me, the stock markets, they come and they go, and making sure your income's buttoned up. It's really understanding your income plan. And once we understand your income plan and talk to you about inflation and stagflation and how that's all going to work and how we can evolve around that, I think that's the first thing we figure out. The income plan, when you come in, we'll do that for you. 1 out of 5 people have written income plans. So when they come in and see us, they're surprised to see how amazing it is, and starting with that. And then that will help us gauge and govern what needs to be governed, what doesn't need to be governed, how much income do you need, how much risk can you afford to take, and then how much can you emotionally, those big emotions, handle so you don't make the wrong moves at the wrong time, right?
So you talk about these different buckets of money. Are you talking about, like, here is your immediate bucket of money that we need, that it's a very low risk. Here's a 5 to 10 year bucket. Here's a 10 to 15 year bucket, and they're all at different risk levels. Is that what we're talking about here? Yeah,
that's more cookie cutter. A lot of advisors do that. Okay, we got 4 buckets. We got the 5-year bucket we're going to live on, and then there's another 5-year after that, and there's another 5-year after that. And yeah, so this is how you kind of turn on these income streams and keep up with inflation. But we definitely take a bigger breath into managing that. But that is part of it for sure. We will use several buckets in the first 5 years, and then several buckets in the next 5 years. And then there's always that long-term bucket that we usually don't need to touch. It's usually a legacy bucket. It's a long-term care bucket. It's the emergency bucket down the road. And so if we can get that thing to double or triple, then those dollars are sitting there. But we don't want to erode our dollars during retirement. We want to live on our money, and we want it to grow, right? So even though we're going from accumulation to decumulation, meaning living on our money in retirement, you still want your money to grow. And we want to grow more as tax efficiently as possible. So yes.
Well, one of the things that you and I have talked about in the past is you can be in the stock market, but you don't have to be at very high levels of risk. When some people think of the stock market, they think of hedge funds, and they think of high-flying stocks, and they think of Amazon and Microsoft and those big names that are all out there. But that's not necessarily how you have to play in the market. And I use the word play loosely there. But you can find places that have lower levels of risk where when the stock market goes down 15%, even your money in the stock market doesn't go down 15%.
Exactly. And here's the neat thing. So I wanted to know years ago, what do the billionaires and the multimillionaires do? And I had to really get to know somebody here locally before he had passed away. And I got an introduction to his advisor. I'm like, what is the trick? And I took that trick and I applied it to what we do here in our office. So the high, super wealthy people out there, they're not putting all their money in the stock market, everyone. They are not. They're putting a percentage in that they know they don't have to touch, but they're making more sense of the short-term investments that are out there and some of these alternatives that are out there. So now we have applied full circle a lot of those investments to our clients' portfolios. And you don't have to be ultra wealthy or ultra rich to actually have them now. So I think our industry is going to change over time. There's going to be more options for private equity because private equity technically over time beats the S&P 500. So being able to sprinkle that bucket in and then some of these other things that the ultra rich are actually doing. And so we are kind of carving that conversation so that the average Joe can have some of this stuff in their portfolio.
So one of the conservative buckets out there, and because we want, some money at risk, some money that's going to grow for us, and then we want to offset that with something that's at lower risk. I am seeing so many commercials right now for gold. And this is supposed to be when the market gets wonky, buy gold. And, okay, so it's up 15% this year, and gold's like $3,000 an ounce. Just in about a minute and a half or 2 minutes, Sharice, give me your take on if somebody says, hey, should I buy gold? I'm seeing commercials all over TV.
God. I would listen to our favorite person, Warren Buffett. And Warren Buffett says gold is the worst investment. He said if you invested in gold over the last 40 years, it was the worst investment to choose. But people go there because it's tangible. You can hold it. You can open your safe in your closet and be like, there's the gold. It's sparkling in your eyes. You feel good about it. And if you're really old school, you're like, I can use it for bartering one day when their whole entire system collapses. Yeah, you could, whatever. But I would say there are so many other investments that are more valuable than gold, right? Yes, gold has gone up over the last couple of years, right? The last 15 years, I think it's averaged like 0. But if you got in a couple of years ago, you're making some bucks, right? So you had to time that. Now you're a market timer trying to figure that out. But you guys think, okay, gold could go to 3,500. Do you think it's going to stay up there? No, when has gold ever stayed up there and it drops back down to 2,000? I'm not going to predict. I'm not going to say, no, don't buy gold. And if you do go buy gold, here's a sensible thing. No more than 5% of your total liquid assets, right? If you're like, I got to buy gold, Sharice, I don't believe what you're saying. I just want it. It makes me warm and cozy and makes me sleep better at night. Then go buy it. Just make sure when you sell it, they're not charging you more than a 4 to 5% commission. So that gold better grow 20%. And because when you sell it, you're only going to get 15%. So it's a lot of juggling, like, holy cow. And in our portfolios, our exchange traded funds, we put some gold in there. So sometimes we'll have more, sometimes we'll have less, right? But we're managing that because it's called active management. So be careful with gold. It is like always a hot topic when interest rates go down or when the dollar goes down or when the markets are, doing what they're doing and we hear these tariff talks. It's not going to last forever, right? Nothing lasts forever. Everything goes up, everything goes down. And gold isn't something easy to sell. Most people never time gold right. I have yet to meet really anyone except really one individual. I'm still not sure he's timed it right every time selling gold because we get greedy and we always want that comfort zone. And comfort zone are chocolate chip cookies, double stuffed Oreos when they're on sale, and gold.
There it is.
Three commodities.
And you can buy gold at Costco right now, which is crazy to me.
Oh my God. Hot dogs and gold. Listen, yeah, go ahead. Okay. You know what, guys? Go ahead. Go out there and get your $1 hot dog. And while you're there, just go ahead and buy your gold. Come on.
Do you want to buy your investments where you buy a big jar of pickles?
Right? I mean, you can go get like a 10-pound gallon of mayonnaise while you're there. Like, I'm not a fan of buying gold at Costco, right? And then when you walk out that door, guess what? It goes down. It's like buying a car, brand new car. It goes down in a second.
Yeah, that's a good point.
So listen, this is why I have financial advisors to talk you off the ledge. I'm okay with gold. I'm not going to totally shun it. We do put it in our portfolios. And remember, for those people that will never call us, I would recommend no more than 5% of your total liquid investment. Oh, hey, and Dave Ramsey and a lot of the other gurus, that's just part of that method is don't buy one stock with 100% of your money, split it up. It's a 5% rule. You're spreading your investment out. So, it's not hard to figure out.
Now we know Sharice's stance on gold. All right. You're listening to Retirement Coffee Talk with Sharice Rivers. Online, you can find us at zinniawealth.com, ZINNIA wealth.com. At the bottom right-hand corner, you're going to see a gold box that says Complimentary Retirement Consultation. That's a meeting to sit down and talk about you, your retirement, where your money is, and what are your concerns. A free meeting. So give us a call on that, 833-368-3680. Again, 833-368-3680. All right, J.P. Morgan did a study about how people spend and don't spend their money in retirement. And they found that if people got 20 to 40% of their income from a pension or pension-like source, they would spend about $50,000 a year. But if you received 60 to 80% of your pension or your pension-like source income, you would spend $71,000 a year. That sounds like a pretty good retirement. Okay, so what is the difference here, Sharice? One group has a lot of confidence and they're spending money, and the other group is a little hesitant to spend money. What's the difference in this scenario?
So let me give you some examples, and I hope I can convey this properly and slowly on radio. I'm looking, when you do it on paper, it's easy to see. But let's assume that you need $100,000 in income, Randy. Okay. And let's say that $100,000, 30,000 is coming from Social Security, 30,000 is coming from your pension, and the remaining 40,000 is coming for the $1 million you saved, right? Mm-hmm. To me, this is a very happy person because they get 30,000 in social, they get 30,000 in pension. So 60,000 of the 40,000 of the 100,000 they need is coming from that fixed income. So they're like, that mailbox money is always going to show up and never goes away. So we feel confident and comfortable, right?
Right.
And then you get somebody who's got maybe 20,000 in social, 60,000 seriously in pensions, and then they have this $1 million saved, and they only need to pull, maybe 20 grand out of their investment. They're super happy. They're like, I'm spending money, I'm loving life. I don't care about that stinking stock market. So they're spending it because they know it's always going to show up, and they don't really want to see it bankroll inside their bank accounts, right? So they just have uber confidence. And then there's this third person that says, hey, Sharice, I saved $1 million. I'm getting 30,000 in Social Security, and I still need my 100 grand. So I need 70,000 from my portfolio. That is the person that is very stressed out. That's the person that's spending less money. That is the person that comes to my office and says, Sharice, I'm afraid to spend any of this money because I don't want to run out of money. And that's because I don't have that extra mailbox money, that pension money, like these other households do. So every household seems to be quite different when they come in. But I think what I want to explain to those special people who are only getting 30,000 in social, or maybe it's 50,000 and you need 100,000 and you saved $1 million and now you're having to pull 50,000 out of your portfolio. You are still stressing out. If you only had to pull 30,000 out of your portfolio and markets are going down, but you needed that 30,000, you might still be stressing out. So making sure your income is buttoned up. Let's make sure all of your bills for the rest of your life are covered. If there's still a mortgage, make sure your insurance is covered, the cell phone, the gas at the pump, the grocery bill, make sure you can always pay that light bill with inflation increases and adjustments, right? And then the rest we can figure out. But if you have your bases covered, you're going to be more comfortable at retirement. And then whatever you need extra, we could figure out a plan for. But what I really want to paint a picture for everyone listening today is this. Go back to the year of 2000, okay? You just retired. It was 1999, and you were loving and living life. The stock market grew over 1,000% from 1980s to 1999. You retired. You're doing the same thing you were doing with your investment when you're working as you're retiring now. And in 2000 hits. That $1 million 401k went to a 201k. It went to 500 grand. Over 3 years, especially if you're following the 4% rule and you're pulling 40 grand out of that portfolio every year. That money will never go back to even if they continue to take that 40 grand out, right? And most people at that point are taking less risk, so they're not going to make as much money. So what is happening today? What if, so those people who forgot that time, what if right now we are in this weird time period and the market goes down 33 months and you're about to retire in a few years or you're in retirement? Now, I want you to put yourself in that place right now. If that happened, what are you going to do? Do you know your plan? Do you know what the strategy is? You know where your income's going to come from now if you have a 60-40 portfolio, and 8 out of 10 people, Randy, do not. I'll fast forward. Let's go to 2007, 8, 9. The S&P dropped 51%. So let's say that was an 18-month decline. Let's say for the next 18 months, the market continues to go down and you need your income. What is your plan? What is your spending plan? What is your mailbox money? Do you even have mailbox money? Do you have to go back to work? Do you have to tell your wife after you're pacing up and down the hallway like, oh gosh, I screwed this up. Woulda, coulda, shoulda. You know, a happy wife, happy life. You don't want to tell anybody. We can't book trips for the next 4 or 5 years because now we got to let our money grow. That is not entering retirement stress-free. So put yourself back into those time periods. What is the plan? And I'm not saying that we're going to have an 18-month decline. I'm not going to say we're having a 33-month decline, but I am saying what if? What is the plan? Because we want to make sure that we tackle that plan depending if you have big pensions or you don't have pensions at all and you have this big chunk of money that you're about to do a meltdown, right? And the meltdown could come now, it could come 10 years from now, but what is the plan?
Well, I think that what Charisse is painting that picture is there's all sorts of uncertainty out there in our future when it comes to markets. And there's a lot of stuff that we can't control. And the people who spend more money in retirement are the people who've built those buckets that will continually be filled every single month. I know that, bringing back Las Vegas into it, when I sit at the blackjack table, I've got 2 piles of chips. One is my money, one is their money. And I'm real happy to spend their money. But then I start getting a little antsy when we get into my money. And I think that's kind of what's going on here, is that people see that fixed, guaranteed income, whether it's a pension, whether it's Social Security, or something that you have created as their money. And you're real happy to spend that money. But then when you start getting into your money, then people start backing off and they stop spending and they don't enjoy their retirement. Let's build you that their money, your money kind of a situation when you go into retirement, so you have confidence to spend no matter what the markets are doing. Give us a call. Give us a look on our website. Here's our number. It's 833-368-3680, 833-368-3680, or our website, zinniawealth.com, ZINNIA wealth.com. There's a gold box that says complimentary retirement consultation. When you click on that, we'll ask you to put in a little information there, and we'll reach out to you. So, Charisse, we just went through tax day just recently, and I know that there's a bunch of people listening to us right now that probably had to write another check to the government. And you're thinking to yourself, well, this will all come to an end when I'm retired. I won't have that anymore. But that's not always the case. People are still writing big checks to Uncle Sam in their retirement years because they don't have a tax plan. They don't have a tax strategy. So there is a certain amount of our money that is going to be taxed, 401ks, IRAs, that kind of money in our retirement years. Charisse, what is the plan for limiting that tax liability as we go into retirement? Because as soon as Uncle Sam says, time to pay up, it's RMD day, baby, all of a sudden, this all starts again, doesn't it?
It does. So there's a retirement myth out there, Randy, and it says, hey, when you retire, you're going to be in a lower tax bracket. And do you know that 8 out of 10 people who's retired, that is not the case? It's the same or higher, right? And it's a myth because in the 90s, there was an opportunity for all the baby boomers out there and so many people to get a Roth IRA. And they didn't, because the advisors made these assumptions because they just don't know what they don't know sometimes. Don't do that. Get the tax deduction off your 401k by contributing. You're going to be in a lower tax bracket anyways. No, your seed is now a harvest. You have this beautiful, beautiful apple tree with a lot of apples on it that you're going to have to eat, and they're not going to rot. And so there's part of it, and they're going to keep growing and maturing. You're going to have more apples, and you're going to owe more to Uncle Sam, and your surviving spouse is going to owe even more, and then the kids are going to owe even more than you could ever imagine. That legacy, if you saved $1 million, say goodbye to 40%. And that's today's numbers most likely, right? And so, yes, tax liability. Nobody wants to write a big check. If you've done well, pat yourself on the back. You're keeping, probably a lot of your money now. But if you don't want to write a big check forever, let's say you're in your 50s and you're in your 60s. oh my gosh, you are in prime time real estate when it comes to tax planning, because when you're 73 and 75, you have to pull money out of your IRAs. And if you got Social Security and pension and you've got $1 million now, and when you're 75, now you're at $2 million. Hey, basic, simple math without me pulling out the calculator, you're going to have to pull 80 grand out of that IRA. If you're thinking, oh, I don't need that. Do I have to? Oh, you do. And then that 2 million in 10 years could easily double to 4 million. So now that 4 million, that's double that money that you have to pull out, right? So how do we protect you from continuing to pay your partner, Uncle Sam, taxes over time? A tax strategy. This is what we do. Very few advisory firms do this. You can go anywhere and you'd be lucky for anyone to say, yeah, we'll do your tax plan. We'll show it to you. Most of them are like, go to your CPA, and the CPA doesn't even show you how to do this tax plan right. And they don't even get it. And half of them is like, don't do it. Don't do a Roth conversion, because they don't even understand it. They don't understand the economics behind it. They're doing your accounting. They're doing your bookkeeping, and God love them. They're amazing, because that's something we don't want to do. You come to us for the tax plan. And if you want to put your head down and do some work over the next 5 to 10 years to lower your tax bracket in the future potentially, and the surviving spouses, because people forget that widow's penalty is deep. It is deep. When somebody passes away, you lose on average 25% of your income, and you're paying 5 to 15 grand more in taxes, and nobody's teaching that. And then when the second spouse passes away, my buddy calls it the kiddos penalty. And boy, you can see a lot of that meltdown happening, because Uncle Sam's coming after that money, because now those kiddos have to cash those retirement accounts out over 10 years. They can no longer stretch it for the next generation or anything else. And so they're paying taxes, and then they're going to pay taxes on it again if they reinvest it in a brokerage account. So how do we beat Uncle Sam? You come in here, we'll do the math, and it's a free analysis on your taxes, which is right now more important than ever, why taxes are still down.
You're listening to Retirement Coffee Talk with Sharice Rivers at Zinnia Wealth. And, right now we're kind of looking at, oh, gosh, help me get through this because the market is all wonky. Well, that's just a part of retirement planning. Not only talking about how we're going to help you right now, but how are we going to help you in 5, 10, 15, 20 years from now when you're in your retirement years? That is a lot to do with tax planning. Let's sit down and not only have a plan for your investments, but let's have a plan for your taxes as well. If that money's in your pocket and not Uncle Sam's pocket, it's kind of like, you just got a little more growth from your portfolio. Give us a call. Let's talk through it. 833-368-3680. 833-368-3680 or online, zinniawealth.com. All right, so one of the things that is pretty common, and I hear this in my own family, is you sit down with a financial advisor and you want to know, when should I, file for Social Security, and they throw that joke at you and say, well, tell me how long you're going to live and I'll tell you when to file. Okay, great. But that is one of the things that happens is we say, well, we're going to build this plan to 95 or 100. And you look at your financial advisor and go, are you out of your mind? I'm not going to live that long. And so if you say, for instance, you retire at 62 and you say, I'm going to build a 20-year retirement, that puts you to 82. Well, a lot of people live longer than 82, And Sharice, let's talk about this. Is this a problem that people think they're not going to live that long, so they feel they don't have to plan that long for their finances?
Oh my gosh, I hear this over and over and over again. Some people believe they're going to live a long life. They want to be ready. And some people think, Sharice, I got 10 years. 20 years ago, I met my first client that said, Sharice, I'm going to die in 10 years. And I looked at him, I'm like, you better not on my watch. I'm like, I don't want that. I'd like you guys way too much. 20 years later, he's still here.
There you go.
We laughed about it. He's like, you were right, Sharice. And planning for a long life is important. And that is a headwind to retirement. And so we just don't want to assume that you're going to pass away at 82. Let's just plan for 90, 95, especially if grandma and grandpa lived the 90s. I mean, they weren't even supposed to live that long, remember? They're supposed to pass away in their 60s, but they didn't. So that was back then. And look at now with all the artificial intelligence and all the things out there that's helping us be better with our health. I mean, health It's just on the rise. People are living it, breathing it, wanting to be better. And if your parents were unhealthy, you're probably much more healthy. Even if there are ailments that you can't stop, you're probably going to live longer. So we need to plan for that. So that's a big thing. You got to plan for long-term care. So, you could be 82 and you think you're going to pass away, but your memory goes, and now you're in a long-term care facility. And if you're healthy, you can be there for 10 to 15 years. And if you're married, you're going to leave a spouse financially destitute if you don't come up with a plan for that longevity phase of life, right? That's why we work with our elder attorneys and implement a long-term care plan without buying long-term care insurance. So we're really big in helping our clients, not just with tax planning and income planning and the stock market stuff. We're talking about elder planning down the way. We got a long ways to go. And, Randy, I want to bring up a buddy of mine. He's a hedge fund manager. He used to be anyways. And now he just manages funds. He sent me a book called Die with Zero.
Okay. I've heard of it.
Yeah.
John McKnight.
John McKnight. Mm-hmm. So I started reading it. And it's everything that we ooze here at Zinnia and that we talk about on radio. And it's memory dividends, memories, creating memories. And let's say you're 62 and you think you're going to pass away at 82. Maybe that does happen. So my question is, if you're going to live, I would still think that's a long life to live. What are you doing with those 20 years of your life? What memories are you making that will be lasting to your grandkids and your kids and other people around you? And because the one thing you don't want to be in is in a long-term care facility, and then all of a sudden you're veering close to death, and then you're just thinking about, I just want my family here. I just wish I would have done more. I wish I would have done more. I have heard that so many times, Randy. I wish I would have done more and not feared running out of money and would have come up with a plan. But at the end of the day, people fear running out of money. They feel like the most important thing is I need to average 6 to 10% a year. And that's not the most important thing, right? And if you read the Bible, it's not the most important thing. It's the memories, it's a family, it's who you serve, it's a legacy you leave in memories and in that servitude. So I just have to, tell people, like, living a long life, you could live to your 90s. I got somebody who's 98 that I saw them when they were, 80, and they're still here. And it's amazing. And I ask him all the time, what are you doing to just keep going? He's like, I'm spending time with my family. I'm creating memories. And this is what we do here. And it's just a really gratifying thing to see people actually leaning in and doing those things because it's important. Because the last thing you're going to care about when you're on a deathbed is how much money I made.
Yeah.
You're going to think about, hey, what kind of memories did I make?
That's really putting it in perspective for right now as well, because if everything that's going on right now has really got you shook up and you're losing money, and I get it because I'm doing the same thing and I hate it. Everybody does. But ask yourself this. When it comes to your life, what are you up against? Who are you competing against here? What are you trying to build your dividends? And is it the stock market? Are you trying to beat the S&P? Is that going to give you joy? Are you going to beat the Dow? Is that going to give you joy? No. What you're trying to do here is you're trying to build memories in your life. Like Cherise says, you're trying to build experiences in your life. And that is, you want to put the money with it, of course. That's what we do here at Zinnia Wealth, is help you put the money together to build those memories. And Cherise, maybe that's a kind of a perspective kind of thing right now that we should think of. Yeah, money comes, money goes. We need to have money to live. But at the same time, we want to use that money to build those memories and not take joy in we're always in the green and we're hitting our goals. But what are the goals?
Randy, you pegged it. I talk about joy all the time. I don't talk about it on radio. Like, I'm just a joyful person. I'm excited to wake up the next day and what's next in life and who can I help and what's the journey like? And you should be like that in retirement. The retirement journey is creating those memories. Go pay for a cruise and go on a Disney cruise like one of my clients just did with all their grandkids and just have a blast. Go rent a house over the holidays in North Carolina for 2 or 3 weeks. If you got the money and you got the plan set up to do so, and just tell the kids, I know they're busy, they're all working, say, come when you can, and just make it available to them. Go down to the Keys, go rent a house over the summer for a couple weeks, say, come when you can, create those memories. Just know that you're grounded and you're planted, and they just know you're there, and you're just waiting for them to come. And that's the big part of that retirement journey is joy. And if you've never had joy in your life, by golly, by retirement, you better have some joy. And if you don't, you get in here. I'm going to motivate the joy in you, because that is what I want people to do. I want to give you hope. I want to inspire you. Joy is what people need, and it's one thing that so many people miss out on, right?
Come on in, and Sharice going to shake her finger and say, "You need more joy in your life."
I know, it's so important. Because I'm so joyful. I love so many things in life, even when the things get rough. I'm just like, I'm good. Let's go. Let's plow through it. And people need that. And I'm going to be your pusher in retirement.
You're the girl who was on Fear Factor. You are the person in retirement who is encouraging people to get out there and enjoy their money. I mean, that is one thing that over the 12 years, 13 years that we've been together, Sharice, some of my favorite stories of you with people in the office are when you look at people and say, you're not having enough fun. You're not spending enough money. Don't you come back here until you book that cruise. I want the pictures for when you're, frolicking around with penguins in Antarctica. That's what I want to see. And don't come in here until you do. And that's so true. I mean, we're not going to shake our finger at you and saying, hey, you made a lot of mistakes in your life. You're not going to have a great retirement. You got to go back to where, you know what? Yes, there are times when the news is great, the news is good, the news is not so good. But we're going to work through all of that. What we want to do is say, go have some fun. Enjoy your retirement. You earned this. And Sharice, I think that's one of the things that makes you kind of jazzed about what you do, is to see people do that.
Yeah, a pastor recently said, Sharice, you are guided by a light. And he's like, I've never seen so much joy in somebody. And he says, I even look for that. He's like, you're definitely led by God. And you just see that you just have this vision. And he said, I can't imagine what your clients feel like when they come in and see you. Like, you must rain and shower that on them. And I hope I do. And after that comment, I said, you know what? I need to make sure I do more of that. So you accidentally brought up joy, which is such a big part of our lives and that we should have. And then if you're younger and you're listening and you're in your 40s and 50s, you can create joy too. There's so many different ways. And we hope to spread that amazing madness around our Ocala and Gainesville and the Villages area, because all of you deserve it and you all work so hard.
Well, money is a tough topic sometimes. And what we want to do is put the money with the memories so you can build those memories. And that's what retirement is. And so let's sit down and have that meeting. We have a number of different ways you can get in touch with us. You can look at our website, which is zinniawealth.com, ZINNIA wealth.com. And there you'll see a gold box. It says complimentary retirement consultation. That's a meeting. It's a meeting to sit down and get to know you and find out who you are, what you're doing, what you've done for retirement, and how we might be able to help. You can also give us a call, 833-368-3680. Again, 833-368-3680. Sharice, that is all the time we have for today. I'm going to give you the last word on this one.
All righty. You guys, thank you so much for your time and your feedback. I hope the show put a little light in your day and bringing some joy to your day, or we're going to help you one way or another. And as usual, live by design and not by default. And we'll see you here next week.
This has been Retirement Coffee Talk. To find out more about how the strategies we've discussed on this program can build the retirement you've been wanting, call Zinnia Wealth at 352-368-3680 or visit us online at zinniawealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Sharice Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and/or categories usually do not deduct transaction and/or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.